You spend an hour carefully plotting horizontal support and resistance lines on your chart. You take a position, place your stop loss, and watch the market price violently blast right through your coordinates as if they didn't exist. That happens because of a critical misunderstanding of market mechanics. A drawn line is a passive, static coordinate. It has no internal power to stop live, aggressive institutional order flow. To fix this, you have to look at the financial market exactly for what it is, a high-speed auction room. In any physical auction room, the walls dictate the boundaries of the space, but the walls do not dictate the price. Only the active auctioneer handling live bids contains the kinetic energy required to move the market. Surviving this environment requires moving past arbitrary horizontal lines. Instead, you need a visual formula that pairs those passive macro boundaries with the active kinetic energy of institutional order flow. The first required variable in mapping institutional liquidity is what we call the structural wall. This grid maps out exact historical boundaries. These are fixed daily coordinates, like the prior day high, the prior day low, and the 9:30 a.m. Eastern Cash Open. Higher timeframe quantitative baselines also serve this function, specifically the 34 and 55 exponential moving averages, along with Keltner bands. These specific coordinates are completely ubiquitous. Every participant with a trading terminal anywhere on the planet can see exactly where these levels sit. But that ubiquity is why they are dangerous. A structural wall possesses zero internal kinetic energy to push a market on its own. Think of it like a concrete wall in a classroom. It represents a hard physical boundary where movement might temporarily stall, but the wall itself provides no energy to reverse the momentum of whatever hits it. Because of this, trading a structural wall in isolation ignores the kinetic reality of the market. You are betting on a boundary without any evidence that the auctioneer has the intent to respect it. That brings us to the second, active variable of the formula, the engine. On this chart, the visual trigger for an engine is the appearance of a massive displacement candlestick driven by high relative volume. Notice how we map a glowing gold line across the exact midpoint of that specific candle. A violent price movement of that magnitude occurs when aggressive institutional selling overwhelms the buy side, leaving a structural imbalance inside the order book. The exact 50% midpoint of that displacement candle represents the fair value equilibrium of that market imbalance. At this precise 50% coordinate, institutions often rest their passive reload limit orders, creating a layer of liquidity designed to defend their initial position. Unlike a structural wall that is always visible, the engine is invisible right up until the moment institutions reveal their hand through aggressive volume and price displacement. Definitive. If your planned execution zone lacks this 50% midline, it has no active fuel. Without that evidence of institutional defense, the setup must be discarded. We can now synthesize these two variables to construct a high-probability execution container, the golden zone box. This visual shows how the container is built. It only forms when the dynamic momentum of an engine sits directly against the macro boundary of a wall. The area between them is your zone. The non-negotiable rule of this framework is simple. Every valid golden zone box must explicitly include a 50% midline. This logic test shows why most zones fail. On the left, we pair a passive wall to another passive wall. Combining two passive variables identifies a boundary, but it provides no information about momentum.
When you draw an execution box between two static walls, say yesterday's high and an arbitrary moving average, you are trading a dead zone. That error leaves you with zero live order flow participation. But on the right side, pairing an engine against a wall merges momentum with structure. This visual filter removes the guesswork of trading isolated lines. It ensures you only commit capital when institutional momentum and structural boundaries align at the same price coordinate. Now we have to address the single most dangerous trap for retail day traders, lower timeframe bait. Lower timeframe charts, specifically 1-minute and 3-minute trend lines, are often engineered by algorithmic market makers to build pockets of retail liquidity, purely so they can be swept. The 1-minute chart on the left illustrates the problem. Basing zones on these microswings means normal market breathing will hunt your stop loss. Compare this to the right side. Higher timeframes hold the actual macro inventory, smoothing out algorithmic noise to reveal genuine institutional structure. Within this framework, the lower time frame serves one strict purpose: precision triggering. You must never use a lower time frame chart to establish your directional bias. You wait for price to enter your macro golden zone first. Only then do you zoom in to the lower time frame to execute your entry. Mixing up this hierarchy turns a valid strategy into a trap. Exposing your analysis to lower time frame noise makes you a target for the very algorithms you are trying to track. Let's move from theory to a practical execution on the SPX chart. Step 1. Scanning the 1-hour chart, we identify a severe downward displacement candle that leaves an imbalance in the book. This generates our gold 50% midline, the engine, at 5,050. Step 2. We locate the nearest passive macro boundary sitting just above the engine for structural protection. A higher timeframe Keltner upper band sits at 5,060. That's our wall. Step 3. We draw our golden zone container spanning the exact vertical gap between the 5,050 engine and the 5,060 wall. As price begins an aggressive rally back toward our newly formed emerald zone, we wait. This is where discipline dictates the trade. As price climbs, the 1-minute chart will flash bullish breakout signals. You ignore them. Step 4. We shift our view down to the lower time frame. Price touches the 50% midline at 5,050, and the bullish momentum immediately stalls, forming long top wicks. We are watching the resting institutional liquidity absorb the buying pressure. We are now waiting for a confirmed nested C, or NC, signal to form inside the zone. The NC signal is the final green light, indicating that the buying volume is exhausted and the sellers are retaking control. With the signal confirmed, we execute the short position of 5,052, anchoring our entry to the institutional reload volume. We place our stop loss above the 5,060 level. Placing the stop above 5,060 uses the macro structural wall as a shield. If price breaks that wall, the institutional premise is no longer valid. By building this zone step by step, we eliminate guesswork and execute where the chart shows institutional activity is most heavily concentrated. To navigate the market auction, stop trading isolated lines. This blueprint summarizes the rules. First, a higher timeframe midline forms one boundary, providing institutional equilibrium. Second, a structural wall forms the opposing boundary, creating a stop-loss shield. Finally, lower timeframe action is for trigger confirmation only. Never execute on lower timeframe structures alone. Stop letting lower timeframe noise dictate your directional bias. To survive the auction, you must locate the engine, anchor it to a wall, and let the golden zone mechanics do the work.